Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies SOFI stock to go over the latest news updates and whether or not Sofi Technologies is still a good stock to buy right now. For more videos like this one, remember to go and smash that like button right now, comment your thoughts down below about the SOFI stock and Sofi Technologies as a company, subscribe if you are new, and without further ado, let's just jump right into today's stories. If you didn't know, Sofi Technologies and their SOFI stock, which is their ticker symbol, is down around 60% this year, and if we compare that to the S&P 500, that has only fallen around 20%, so clearly it has been a very bad year for the SOFI stock. So clearly Sofi Technologies and their stock price is struggling to see a bottom, but once it hits a bottom, many professionals actually think it's going to rebound. Now, if you don't know what Sofi Technologies does, they are a fintech company, and they offer an all-in-one inclusive digital app which gives their customers anything they could probably need in terms of financial services and or financial products, from refinancing student loans, from taking out a mortgage, to debit cards, credit cards, and even savings accounts. So they are basically operating as a completely digital bank. You have an app that operates as its own banking institution. However, recently, Sofi Technologies has not been performing very well regarding their stock price appreciation for their SOFI stock. But according to Yahoo Finance, their entire sector has actually been under fire lately because other technology companies, specifically technology companies or fintech companies revolving around the finance space, such as Affirm and Upstart, have been absolutely plummeting as well, even more so than Sofi Technologies SOFI stock. Even older sector leaders such as Block as well as PayPal have also suffered extreme stock price decreases over the last couple of months. Right now, the SOFI stock price is trading at around $6 per share. However, because professionals project that the company will bounce back once it finds a bottom, this is going to be good for long-term investors, and we'll talk more about that later in the video. Now, the reason why the SOFI stock price is falling is not due to the company itself, their overall market share, or how their management is executing their plans to reach their overall goals. Right now, the stock price is very low, which is good for investors who can't purchase fractional shares or shares in certain slices. So for instance, if you are talking about a stock that is worth $1,000, if your brokerage platform allows you to invest into it on a fractional share basis, you could buy as little as $1 of that $1,000 share. However, because the SOFI stock price is so low right now, investors don't even need to have fractional shares enabled to own stock in this company. So the overall goal for Sofi Technologies is long-term price appreciation because this is a growth company. And right now, their management, in my opinion, as well as the fundamentals of this company are very solid. And many people, including professionals, have opinions that are not only unfounded, but are absolutely covered with multiple errors, which I have addressed in previous videos. Also, according to Yahoo Finance, Sofi Technologies has quadrupled their earnings over the last 4 years, which is absolutely fantastic. But despite this, the stock price continues to fall lower. So even though the company itself is building upon itself and they're rapidly growing, investors just don't think that it's worth the money right now considering the overall stock market environment. But it's nothing to do with the fundamentals of the actual company. The management is operating very well. They're growing their revenues, they're quadrupling their earnings, and they are increasing their overall market share. Also, Sofi Technologies is very stable, and they've actually have held their own because many companies in the fintech space are falling right now, including Upstart, which we talked about earlier, which fell around 60% after their latest earnings report, even though the company itself has grown its business around 150% in that same amount of time. So as we see from the fintech space, these companies are falling not because these companies are inherently bad, but because the overall stock market is falling, and clearly these stocks make up the overall stock market. Now, particularly financial companies and fintech companies are being hit harder due to rising interest rates. However, I actually have the opposite opinion because these are the companies that can offset the risk of rising interest rates by increasing the interest rates that they already offer. So this allows them a small buffer when compared to other growth stocks to actually offset the amount of interest rate increases from the Federal Reserve. Currently, around 11 professionals cover the SOFI stock price right now and SoFi Technologies as a company, and overall they give it a moderate buy rating with an average price target of around $11, and considering that the current stock price is around $6, clearly it's going to appreciate over the long term, or at least over the next 6 months according to stock professionals. However, even professionals on the very bearish negative end of the spectrum, including critics of SoFi Technologies, thinks at minimum that the company is worth around $7 per share. SoFi Technologies is likely to make money for very patient investors who are willing to hold this company over the long term. And when I say long term, I am referring to holding this company regardless about what the stock price does over the next 5 to 10 years. So clearly SoFi Technologies is going to pay homage to their long-term investors who have a very long-term time horizon, because the longer you hold this particular company, the more time it has to actually bounce back. Also, I do want to say that despite experts projecting that the United States will register an official recession in the next 3 months, which will negatively impact the stock market and the overall economy, we don't anticipate that this will last over the next 2 years. However, what do we do with risky single stocks? Well, if you all know me, even in a good economy, I don't allocate more than 5% of my overall portfolio weight to one single company because, in my opinion, that's bad risk management. Also, we need to remember to diversify, and some people and investors don't like to diversify because they think somehow that it harms them, but it really doesn't. Just answer this question: would you rather invest into one single company that's really good, or multiple great companies that are absolutely fantastic? Well, the better option is to invest into the multiplicity of companies, because even if one of those companies go out of business, you still have the other companies that are going to make up for any lost value. However, if you put all of your eggs in one basket and you only invest into one company, and that company somehow goes out of business, or something very dramatic happens to that company, you have lost all of your money, so you've taken on unnecessary risk. So diversification is going to split your risk into multiple companies. However, I would advise to only invest into strong, good companies such as blue chip stocks. As far as single growth companies such as SoFi Technologies, Palantir Technologies, and other companies such as Upstart, Affirm, and even Block and PayPal, we should be more hesitant to buy these companies. But if you are already dollar cost averaging into a very strong ETF, mutual fund, or index, and you already have a strong foundation of blue chip stocks that would be composed of both defensive stocks as well as dividend stocks, then there is no harm by doubling down on your high conviction single stock growth plays, such as what I am doing with SoFi Technologies. However, as of right now, I only have around 1% left to invest into SoFi Technologies to average down my average cost basis to around $7 per share. And I do plan to hold this company regardless about what the company does over the next year or two, because I think in the year of 2024 and 2025, the stock price is going to start appreciating very rapidly because the company is projected to become profitable. Another thing I want to point out is that tomorrow is going to be when SoFi Technologies and their shareholders vote on whether or not to give their management the ability and the authority to perform a reverse stock split. Now, even if that goes through, it's not a said and done thing where management will actually initiate a reverse stock split. However, if investors do decide to give that authority to SoFi Technologies management, I'm going to view this as a very negative catalyst, which could push the SOFI stock price even lower. Now, I do want to say that, remember, the long-term bullish thesis for this company is still intact, and I'm going to point out 2 reasons for this, and it's because of 2 companies that they have acquired, which I used to talk about a lot back in the day. So first, we're going to talk about how SoFi Technologies is positioning themselves to become the new Amazon Web Services of the banking industry. And if you didn't know, Amazon Web Services operates and is one of the most successful cloud services in the entire world right now. And SoFi Technologies wants to take a similar business model and apply this cloud business but to banking. And I think this Motley Fool article correctly identifies SoFi's long-term goal. And I also like how the author lays this out very simply. For instance, the article says, and I quote, that SoFi took a giant step to becoming the Amazon Web Services, which is also AWS, of fintech when it signed an agreement in April 2020 to acquire Galileo, one of the best financial services companies for building payments, checking, savings, credit, debit, and other money transfer functionality, end quote. So basically what this author is trying to convey is that when SoFi Technologies acquired Galileo, it put them one step further to accomplishing the goal of becoming the Amazon Web Services of the banking industry. SoFi bought Galileo for two main reasons, and the first reason is to innovate on their payment features and its overall banking platform to make it not only faster, but they can operate it at a lower price. So this is going to lower their cost basis. The second reason why they acquired Galileo is that SoFi Technologies believes that many fintechs and banks are going to be heavily reliant on Galileo's services. And the reason why this is absolutely paramount to SoFi Technologies' growth is that SoFi Technologies also has banking customers. They don't just sell to individual customers such as you and I, but they also help other banks with the Galileo technology. So as you can see from the chart on screen, the membership increase of the Galileo accounts has absolutely exploded ever since they were acquired back in 2020. So clearly, this was an absolutely phenomenal acquisition from SoFi Technologies' standpoint. I also want to add that SoFi Technologies also acquired another company named Technisys, and this allows them to reinforce a multi-product core banking platform, which is going to be Technisys itself. And again, there are two reasons why SoFi Technologies bought and acquired Technisys. The first is to combine the Technisys banking platform with Galileo services so they can combine these businesses to benefit each other so SoFi Technologies doesn't have to rely on a third party. They are literally completely internally sufficient because of these two companies and the synergy between them. The second reason for this is that SoFi Technologies expects their core business to gain substantial cost savings. So by implementing and acquiring both of these companies and having them work together internally instead of hiring a third party, this not only lowers SoFi Technologies' expenses and various costs, but it also increases their revenue on a compounding annual growth rate. So this is not only saving them millions and millions of dollars, but it's also gaining them millions and millions of dollars. I also want to mention how Technisys has actually integrated its platform with Microsoft's cloud for financial services. Technisys also allows companies to gain the ability to increase, innovate, and scale up their operation even for other large banks that have around 150 million customers. Now, the only problem I see here that the author of this article rightfully points out is that SoFi Technologies is not only making money from everyday consumers such as you and I, but they are also helping out other banking institutions which pay SoFi Technologies to use their technology. However, if these banks catch on, this is going to be a long-term threat to those banks individually. This is a similar reasoning to why Walmart does not use Amazon's AWS because they view each other as competitors, so they don't want to use each other's technology because that would be helping out their competition. In a similar way, banks who use SoFi Technologies may eventually start to gravitate away from using SoFi Technologies services to operate their various banking platforms and products. And the reason they can do this is that other financial institutions actually have other options available to them, such as Marqeta and Stripe, which can arguably innovate and help these companies out just as much as the combination of Galileo and Technisys from SoFi Technologies. So clearly there are other options for these particular financial institutions to use outside of the technology that they are currently using and paying SoFi Technologies for. However, with that being said, Galileo and Technisys do have a solid global presence. So even though SoFi Technologies is particularly in use in the United States, Galileo and Technisys is worldwide. They have a worldwide reach. So even if the United States financial community ostracizes and decides to boycott or not use SoFi's technologies within the United States, luckily Galileo and Technisys have a good fallback plan because they are being used in other places around the world, such as in Europe and South America. So even if the US market doesn't work out, they still have the ability to obtain market share elsewhere in the entire world. So that is a very good fallback plan. But with all of that being said, what should we do with SoFi Technologies, and is this company a good buying opportunity right now? Well, I want to say that I've mentioned this in a previous video, that the price to book ratio for this company is hovering at around a 1. And this would indicate that this company could be undervalued right now, because this is one of the things that value investors look at to identify whether or not they should buy a company or not. So this could bring value investors into this particular company. Not to mention that this company, in my opinion, is also a phenomenal growth company because their revenues rose by around 69% in the first quarter, and some investors might regard this as a fantastic opportunity to not only buy and identify an undervalued company, but a fantastic growth stock that is supposed to appreciate in price over the long term, but not necessarily anytime soon. So right now may be a good time to buy a couple of shares if you are already not overexposed over 5% in my personal opinion, but always make sure to do your own research on these companies, figure out if this company matches your personal investment goals, strategies, and if this would make a good addition to your portfolio. But with that being said, I would love to hear your comments down below about SoFi Technologies. Remember to go and smash that like button for more videos and news updates on the SOFI stock price. Subscribe if you are new, and I will see you in the next YT video.